Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. I greatly appreciate all the comments and support. This week up, FedEx, the monster global distribution company and shipper. We're going to take a look at 9 years of historical financial information, figure out how much cash money FedEx generates, and then look at a forecast to see how much cash they're going to produce in the future and figure out how much we can earn by holding the stock today. You ready? Let's get to work. Okay, behind me is the 2021 FedEx annual report. Now, FedEx's annual report is filed as of May 31st each year. So this is going to be May 31st, 2021 and back 12 months. Behind me is the data that we're going to go through. And before we dive into this data, I want to cover the 5 key attributes that we cover at this channel on all of our securities to help us figure out what is a good investment, or at least a starting point for a good investment. And those 5 key attributes would be, number 1, top line revenue growth. You've got to have top line revenue growth. EBITDA growth is the next one. I got to see earnings at the enterprise level growing. 3rd, strong free cash flow. That's paramount, strong free cash flow. 4th, we want low debt. We look at debt to EBITDA as a ratio. And then well-priced, we need a well-priced stock being enterprise value to EBITDA or free cash flow yield. One of the two basically needs to produce an IRR on the investment that's greater than holding an index fund. That's what we're looking for. We want to beat the market. So to do that, you have to buy stocks that meet all those criteria, and you have to get them at reasonable values. Not necessarily dirt cheap, but you just don't want to pay too much of a premium. So let's take a look at FedEx and figure out how they stack up on those 5 key factors, and we'll talk about what we think we can earn on the stock in the future. So behind me is their revenue. Again, May 31st and forward is the fiscal year. So 2013, they made $44 billion. That's a lot of jack. Good for them. Kudos to the people at FedEx. Really did a great job with a nice big round number. But what happens there, the next almost, 9 years or so, it's fairly flat. With a noticeable spike here in 2021 of $83 billion. When I look at this as a kind of average, the kind of average CAGR is an 8%, but that 8% growth rate is dominated by this big spike here between $70 billion and $83 billion. But it does click along, so it definitely checks our box. This spike here, incidentally, is driven by COVID and the stimulus checks. I worked for previously a consumer products company who used FedEx to distribute our product to our customers. And in dealing with them, I learned that, and this isn't anything proprietary, but I learned that FedEx was so overbooked by customer demand, being like predominantly e-commerce companies that are shipping products to their customers, that they were turning down business and pushing price increases to the remaining a customer base because every single plane they had was simply full. There was no more room to put any packages. So what they did is they upped the prices on everybody and then cut the bottom of 10% of customers that couldn't afford the shipping price anymore. So they boosted their revenue through a combination of completely full utilization on assets and then higher pricing. So that's great. Fantastic. The question is, what happens in the future? Can that 100% utilization be sustained? Would it grow beyond that? I think that's a big risk here that we'll talk about in the future. EBITDA is our measure for earnings. We want to see an enterprise level earnings that regardless of earnings per share, we want to make sure the business as a whole can grow, both top line and bottom line, if you will, EBITDA. And it does, $6 billion all the way up to $11.8 billion in the most recent year. This here is largely low growth. That averages 3%. On that period of time, and then with this spike, it gives us an 8.5% CAGR. That's consolidated compound annual growth rate, by the way, CAGR. But really, 8.5. I can't take 8.5% and stretch it out in the future because that would assume that something like COVID and government stimulus checks happen every single year out forever in the future. I can't do this. So we're going to take a much lower growth rate. This 3% is what they've been using historically. I'm going to tack 3% onto this number and go forward. But let's keep finishing out the metrics to figure out what their enterprise value is worth. Debt. They do have debt, quite a lot of debt in terms of a number amount, right? $7 billion, it grew to about $40 billion here. And they actually have some pension liability, which I've included Yeah, about $3.5 billion of pension obligations are wrapped up in this debt figure. You will also see this debt figure spike from, say, 22 to 40, 41. That's when accounting standards required them to put capital leases onto the balance sheet. So the entire debt got lifted in the company. But nevertheless, $40 billion of debt. We'll figure out what to do with that in a second. Market cap is shares outstanding times price. This is the share price average for May, which is their fiscal year end, times the fully diluted weighted average shares that they have, $30 billion up to $84 billion of market cap. When I add these two, I get enterprise value of $124 billion, which is almost double what it was just the previous year, $75 billion. So it seems to me like the market is giving full credit for the COVID bump in earnings and thinking that's going to stick around, if not continue to grow. That's what you're seeing with this giant move. There's really no cash on hand. They have cash, right? They have, I think it's $6-ish billion of cash on hand, which is a lot of money. But this is a really big organization, and they need all that cash to weather business storms, to run the business. It's very capital intensive, so I'd expect them to hold cash, and that's not excess cash that we would use when we exclude it from our enterprise value. So there's no excess cash right now. If I move on to our multiples to figure out, is this company cheap, expensive, where does it sit? You can see historically it would trade for single-digit EBITDA market multiples. Why? Because growth was 3%. So if growth is 3%, you would expect a lower market multiple. And then recently it's grown, it's actually come down. I mean, 10.6 is still a low multiple in my opinion for a company that is as big and stable as FedEx. So it might have been, say, let's see, super cheap in this range, probably fairly valued at a 10 times multiple, maybe a little rich at a 13. But I don't think these multiples are too crazy. I definitely think a 6 multiple for a FedEx 9 years ago was absolutely cheap. And that would have been the time, any time in 6, 8 would have been the time to buy for sure. And look how long it actually, incidentally, was inexpensive, right? So you can find stocks that will sit there and be inexpensive for many, many years before they start having market multiple expansion and get expensive or more expensive for their relative earnings. But that's the EBITDA market multiple. Nothing screams out of whack here, so I think that's a pass for me that does meet the value test. Net debt to EBITDA, so I'm looking at total debt against earnings that they have on an EBITDA basis, and you can see when they had to add the pension, the pension, and had to add the capital leases onto the balance sheet, you can see their debt ratio spike. They became aware of it, obviously, and started applying cash towards that. With this most recent bumper year that they had, they took a sizable chunk of cash and paid down debt. So they brought actually our leverage ratio back down to close to 3. I'm going to give that a pass. That's close enough. 6.5 would obviously not being a pass, but just over 3 I'm fine with. So that would pass our MAC, especially since they've been historically much lower, and I expect them to pay that down in the future. Okay, so let's recap a little bit. Revenue growth, yes. EBITDA growth, yes. Well priced. It looks like it's well priced. And then low debt, yes. I would give that as a low debt as well. Let's take a look at free cash flow. All right, let's talk free cash flow of FedEx. So you can see cash flow from operations here. This is CFO's cash flow from operations. It's the first third of the cash flow statement. I'm pulling these numbers from their 10Ks. And this follows, the patterning follows EBITDA, which is nice. It's a good accounting smell check that they are expensing on the P&L and income statement the costs that they're incurring, and those are translating into cash, which is a nice. The numbers don't have to be exact, but you want to see the general trend to be going the same direction, which is good. Largely flat through here, $4.6 billion to $5 billion. There's really not much growth. And then a monster, absolutely monster spike, a doubling in 1 year. $10 billion or a 10% annualized growth rate. That's where they came up with the money to buy down the debt. And they're also making bigger investments into infrastructure for their planes and so forth going forward to help, I'm assuming, fill some of the, or add capacity to a system that is 100% full. CapEx is much larger than we typically see for businesses. In fact, let's take a look at if I do CapEx divided by the cash flow from operations, and I look and see what that is as a percent of cash flow, 60%, sometimes 100% of all free cash flow is put back into the business in CapEx in terms of planes and equipment, buildings, infrastructure, just to keep the machine running. This isn't necessarily growth cap, although buying more planes to expand the business would be growth capitalism. What I mean is it's not them acquiring some other just shipper in another country. This is them investing in themselves. And that is a tremendous amount of investment, which means there's not a lot of free cash flow to invest, to distribute to the investors to buy that stock or to go out and make acquisitions, to be really, really aggressive on the growth. So I think that's why you're seeing top line revenue growth, mid-single digits, EBITDA maybe 3%, because the most of the cash they generate has to go to keep the business running, and only a small bit of this is actually growth cap. Right? For example, if they bought planes a decade ago and they have to replace one plane with another, well, that new plane's cost is in here. So that's not incremental CapEx, that's just maintenance CapEx. So some number out of this $6 billion is going to be for growth and some number is going to be maintenance. We don't know the split, but I would guess most of it's for maintenance because the growth rate of the business is so low. All right, so that gives us a kind of a cautionary tale, definitely different from the software businesses that we've looked at in the past, right? Those have a whole lot higher free cash flow margin than a big shipper like this. Debt payment, this is where I was saying before that debt was growing, right? And because these numbers are positive, this is them borrowing and bringing cash into the business as they grow. They're financing these airplanes or the package units, whatever they're doing, because it takes up so much of this free cash flow. They finance a lot of their CapEx, and it's hard assets. Banks are willing to lend on hard assets for sure, so they're able to do it. So this cash comes in, offsets some of the cash they have to spend to buy equipment, and then when I sum this, I get a free cash flow for the business, which is fine. It does end up growing debt, which is what we saw over time, but they're fixed assets and they're financeable, so it's okay. Not great, it's okay. And then this last year here, free cash flow took a dip because they bought down a lot of debt with that extra cash, that kind of bumper year. Overall, decent cash, not robust, but it's not negative, so it's definitely going to pass. It's just not as wonderful as I would like. Shares outstanding is declining 2% annually, roughly, and again, that's them, borrowing on the assets, having some free cash flow, even though it's fairly small, it's still some, and they're taking some of that free cash flow, they're buying back shares in the public market, tearing it up. So if you own the stock, you don't have to do anything, and the percentage ownership of the business that you own slowly grows as they remove shares that are outstanding. That's a great sign. Right, one of the trifecta that we typically see or look for in a business is a business that can buy back shares, so your percentage in the business grows over time. You want to buy at a low market multiple so that when that market multiple expands, you get market multiple expansion. And third, you want a business that can grow its earnings, because that growth in earnings with a higher market multiple compound. That's how you get the exponential growth rate. And you can see it here in this business here. Had you bought it almost a decade ago at 6 times, there would have been 317 million shareholders outstanding for $96 per share. Then it's tripled in value in 9 years, which is something like 33% return. No, it's less than that. It's probably 25% return, but a fantastic return for a company doing 3%, right? So earnings is growing predominantly here at 3% over this time frame. They're buying back shares at 2%, and the market multiple expansion goes from 6 to 10. Those 3 factors combine to take your share price from 96 to 314. And what you want to do is you want to buy a company here, not necessarily here. So I think that's my one issue with this stock. You're buying it right at the end of a absolute monster year, and I'm kind of thinking, how much higher can this market multiple go? How can this number be sustained? I think that's your risk. But in summary, I think all 5 of the metrics can be filled out. But let's take a look at the IRR to see if we buy the stock, what does it earn? Then we'll do our 5 key metrics and review, okay? Let's forecast EBITDA. Okay, so here we go with EBITDA. I'm going to pick up the 2021 number and I'm going to grow it 3%. Because the 3% is the historic growth rate excluding last year's bumper year. I think that's a conservative assumption. If they beat it, fantastic, but I want a stock that produces a strong return for me with conservative assumptions to protect my investment. So at $12 billion, long-term forecast 15.7. I'm giving the average market multiple of 9.6, probably a little higher than cheap, but it's a reasonable number, slightly off of 10 for a business that is continuing to grow, although very, very weak growth. That gives you $151 billion of enterprise value, less debt, $53 billion. We use the same debt to EBITDA ratio just to come up with that estimate. That gives me just shy of $100 billion of market cap, divided by fully diluted shares currently outstanding 268 million, gives me a price target of $363 per share. If I move this up to free cash flow, I'm taking free cash flow per share of $15. I did not use the debt payment that they made. I said just cash flow from operations less CapEx. Hold the debt kind of flat. I'm not neither growing it nor paying it down in the future. I'm just leaving it alone. Gives me $15 a share, grow that at 3% to 20. I apply a 6.5% yield to that, which is roughly the average yield that they have experienced, and I get $341 per share. All right, when I look into the market now that we have an estimate of what we think this business is worth, I can look into the market and I can see I can buy all the shares I want at $267. All right, fine. What do I think it's worth? Well, between these two numbers out 10 years, right, it's going to be $352. Rough range, fair value at a conservative forecast. If I put this in an IRR where I'm buying the business today for $267, I now own a business that's going to generate cash flow every year, which they can go buy more shares, which my ownership will go up, and that would move my long-term number up because I'm not assuming any extra share retirement. They can dividend all this money out, which is what I'm assuming, or they can do some combination of dividend, buyback, and maybe other acquisitions or whatnot. But it would affect this long-term number. So I've assumed it's just dividend all out, and what I get is a 10% return, which is a market return. So for me, it's a good return. It's market kind of standard. It's not something I would go for. But I think the risk here, as I said before, is that large number that they printed in 2021 that may or may not be repeated. It could even retreat. I mean, when I look at consumer data of the retail industry as a whole is absolutely going gangbusters, and it's the highest retail index number we've ever had. So there is a possibility that could contract, in which case the volume of shipments that these guys are shipping could contract. So there is downside risk here, and for me, when I look at the return on a company of 10% and the downside risk of an overall contraction, what that would do to this price, for me, I'm going to give it a meh, because I'm not convinced we're going to collapse, but also I'm not the return here isn't as high as I would like it. And let's review our 5 key attributes right now. So top line revenue growth, yes, it checked the box. Earnings growth, EBITDA, correct, checks the box. Strong free cash flow is good. It's not great, but it's good. I'll check that box. Low debt, yes. Check the low debt box. Well priced, no. I'm going to say it's not well priced because this return for me is market, but as a higher risk component that if there is a slowdown in the economy, this price is going to fall hard, and it's going to be down for the duration of that kind of recession or economic downturn. And I don't want my capital tied up in a business like that when things become cheap and I can go buy phenomenal companies at a much better discount. So for us at the channel, it's going to be a pass. So as we always do, we're going to give you a distribution curve or a chart of pricing. So $267 where it's currently trading, it's producing a 10% return with these numbers. If I hold these numbers, this forecast, which is a complete guess, if I hold this constant and just vary the price, I get different investment returns. As the price goes up, my return falls, obviously. But If the price stumbles, then the return gets really healthy. And for something like this, FedEx is a company you buy kind of within a recession, because it's such a great bellwether. You want to hold it long term. It's a great piece to have in the portfolio, but I would definitely buy it when it's cheaper, and it gets really cheap, much like the railroads and so forth in economic downturns. So this has been a review of FedEx. Like I said, I really like the company. I love that they're able to grow. They're doing the trifecta, is kind of what we want to see, right? Earnings growth, EBITDA's moving it. They're buying back shares. Market multiple expansion. I don't think you're going to get too much more expansion here. So for me, you wait until that market multiple comes down, then you pick it up. If you like what I've done here, you can visit my website, cashflowinvestingpro.com, and I will give you this worksheet. I teach a course that lets you understand how to read 10Ks, how to build out or how to pull out the information you need to populate this sheet, and then how to forecast. And you can do your own stocks. There's no sense in waiting for me to do them. Learn, teach yourself how to do it. Almost anyone can do it. I promise you, with practice, you'll get very good at it. And you will see over time that it really affects how well you do in the market, a little bit of research. All right, my name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments. Please hit the subscribe button if you like that. I greatly appreciate it. And I'll see you next week. Thank you. Bye-bye.